Yo, what's good everyone? Welcome to part 3 of the course. We're going to be talking about the basics of Forex, and in today's video, I'm going to be explaining what is Forex and why I chose it. So Forex, or foreign exchange, it's a global marketplace for exchanging national currencies. And when you make a Forex trade, you're selling one currency and buying another. Understand that the Forex market is the largest financial market in the world. It trades roughly $7 trillion a day. Now, for perspective, the stock market still trades roughly in the billions every single day. The Forex market is trillions. Trillions with a T, bro. So understand that, in Forex, there's going to be major players such as banks, institutions, hedge funds, governments from countries, all kinds of stuff, all kinds of massive whales are going to be participating in this industry. So no, it is not a scam. Understand that, there are major people in this industry. So for example, let's say whenever you deposit your money in a bank, the bank is using your money to participate in these types of markets. They're leveraging your capital and making massive gains off of your capital. There are major players in this market. It is not a scam, bro. So whoever told you that, they lied. Okay. So think of buying a currency as buying a share in a particular country, just like buying shares of a company. So let's say the stock market. When you buy you buy shares, or you buy a stock, you're buying shares of that company. The Forex market, when you buy a currency, you're buying shares of that country. And these pairs, or these currencies, they're always going to be represented as symbols, just like stocks. So for example, in the stock market, you have Tesla represented as TSLA. In Forex, a currency is represented by its symbol. For example, the euro is represented as EUR. This chart pretty much breaks it all down, all the symbols, the countries, their currencies, nicknames. All of it's not that important to know. Just know that you're always going to have a symbol to represent that country's currency. Now, let's keep it moving. So basically, these currency pairs are always going to be quoted in pairs. These currencies are always going to be quoted in pairs. So the price for a pair is how much of the quote currency it costs to buy 1 unit of the base currency. So basically, this right here is saying 1 euro is equal to 1.35 US dollars. So it's going to cost you $1.35 to get 1 euro under this exchange rate. So for example, let's say you go to Europe. You can't use US dollars there, I don't think 100%. But anyways, you're going to use, an exchange. So you're going to give them 100 US dollars, and, roughly you're going to get back, let's say, $95 or 95 euros, right? So and then let's say you go over there for a week or whatever. You don't spend a single dollar, or you found other ways to spend money, but you don't spend any of that 100 original US dollars. And when you come back to America, you go to exchange that and get US dollars back. You're not going to get $100 back. Maybe, because this exchange rate right here is always fluctuating, and based off that fluctuation is going to depend on how much money you get back. You might get $115 back. You might only get $80 back. You have no idea, but just understand that that's basically what is happening. And when you do that, you are participating in the Forex market, whether you know it or not. That's exactly what major players do. The only difference is what we do as Forex traders is basically, we're not going to these countries to do the exchange. We're doing it right from our phones or our computers. That's the only difference. But that is what we're doing. We're capitalizing on the exchange rates and price fluctuations in those exchange rates, and that's all we're doing. Let's keep it moving, man. So understand that there are going to be major currency pairs in this industry. You have everything that has US dollar in it. That's your major currency pair. These are your most liquid pairs. They have the most volume, and I recommend that you trade them. But not to be hypocritical, but I do trade a minor currency pair. I trade GJ. GJ is the only pair I trade. That is my baby. I just see the moves on it, so simple, and it's just easy for me to see. So with that being said, guys, you have to pick what pair move that you see the easiest. You see the movement, it's easy, and it's just it just flows for you guys. So what I recommend picking from the majors, or at least a minor currency pair. Don't trade exotics. Exotics, like USD ZAR, bro, don't be trading that crap. The peso, don't be trading that crap. I mean, it sounds cool, but I just wouldn't recommend trading that. You want to be trading the big major currency pairs because they have the most volume. They're actually going to be moving, and you're going to be able to capitalize on market movement much easier. So why did I choose Forex? It's pretty simple, man. It's just what I was introduced to. If I was introduced to the stock market, maybe I'd be a stock trader, but I'm not. I was introduced to Forex, so that's why I chose Forex. Now, for you might be coming in and being like, well, why would I want to choose Forex? Well, It's pretty simple, man. It's really flexible. The Forex market's open 24 hours a day. So let's say you work a 9 to 5 job and you can't be in front of your computer during New York session. Therefore, you can't trade the stock market because you can't be in front of your, you can't have your phone or your computer. How are you going to execute your trades? But in Forex, there's London session, there's Asian, there's all these other different sessions that you can trade. So like, let's say, you work a 9 to 5, you can trade London session and still go to work and do all that stuff. So there's just, it's just more flexibility to it. And then also there's just less barriers to entry. So for example, if you go in the stock market, there's the pattern day trader rule. So it basically states that if you have less than $25,000 in your account, you can only place 3 trades within a 5-day trading window. So, and then if you trade over those 3 times, basically your account gets flagged as a PDT account, which is pattern day trader account, and you have all bunch of restrictions and shit like that. And to be honest, I mean, coming in as an 18, 19-year-old kid, I didn't have $25,000 to put into account. But then I look at Forex and I can start up an account with, $50, $100, throw it in a broker, and I'm good. There's no restrictions on my trading account. I can do whatever I want with it. So for me, that's why it made sense. There's just less barriers to entry. And then, like I said, the markets are open 24 hours a day, whereas the stock market, it's 9:30 open to 4 o'clock close. Now, with that being said, this information is applicable to both markets or any financial market, out there. Price action is price action. Market structure is market structure, and points of entry are just points of entry. Like you can't reinvent the wheel with that. So with that being said, all this information in this course, you're going to be able to use it in the stock market. You're going to be able to use it if you're trading, if you want to get into crypto, any other asset or any other financial market, all this information, you can use it over there. So with that being said, guys, you need to pick what market, fits your lifestyle best. And if it's Forex, awesome. If not, hey, whatever, man. But still rock with this course and still rock with this information. Appreciate you guys watching. I'll see you on the next one. Peace.